How is income from trading stocks taxed in Canada? While we're at it, through this video, you'll also understand how trading in crypto, in foreign exchange, and flipping homes could potentially be taxed. We'll answer all those questions in this video.
Money does not possess me. Money? Or is it money? Somebody gonna have to tell the truth, and I'm gonna tell it.
By the way, this is a response to a subscriber who has had some success as a DIY investor, and he's now wondering how his income is going to be taxed. This video is for you, Brian. I told him that I can't give him any specific information as I don't know his situation well enough. What I can do though is share some principles that I've read and how the CRA could potentially rule in taxation of trading activity. I'm also not a CPA and I don't currently work with traders in their financial plans. I'm also not a day trader myself, hence the lack of Lambos in my garage. So please take this video for information and entertainment purposes only. I'm not responsible for any tax decisions you make out of this. First of all, why does this even matter? Why do you need to know? Why is the classification of income so important? Well, depending on income classification, you could end up having to report everything you make in your investment as a taxable income. Or you could also end up only paying on half of it. Yeah, 50%, baby. 50% off! That's because if your income qualifies as capital gains, you will only pay on half. Comparing that to the potential that the CRA might rule your income as business income, that would be 100% taxable. So if you made 10 grand and you're at a 40% marginal tax rate, you could end up with a $4,000 tax bill if it was business income. Well, if it was capital gains, you could only end up paying $2,000. My daughter tells me to always shop the sales. So I would like the $2,000, please. Thank you very much. Well, stop. Hold your horses. No, sir, because you don't get to decide that. Unlike the United States, where they have a clear distinction between short-term and long-term capital gains, anything you buy and sell for less than a year, you'll pay short-term capital gains and it is 100% taxable. In Canada, we don't have those specific rules. We have principles. And they are as clear and as transparent as our current leadership. Redacted. Determining whether you pay business income or capital gains is simple. It all boils down to your intent at the time of purchase. All you really have to do is show the CRA what you were thinking at the time when you bought the asset. Whether that's Bitcoin or stock or real estate or cars, it's real easy. Just make sure you get Spock or any Vulcan to do the mind meld and stand witness for you.
One and together.
In the off chance that you can't find a Vulcan, have no fear. The CRA has released a few interpretation bulletins to guide us. You can look up IT 479R, IT 218R, IT 459. There's also Income Tax Folio S3F10-C1, which tells you not to conduct any business activity inside a registered account, like the TFSA, RSP, RESP, RDSP, because you could get in a lot of doo-doo.
There's a lot of fines.
After this, you could also watch Shay, the Humble Trader. She is a day trader, though I doubt that because, again, she shares the same affliction of not having a Lambo. You could also look up the video from Your Friendly Neighborhood Lawyer if you want information on how this could potentially apply to cryptocurrency. Watch their take on it. The crypto video actually goes through some case precedents from Canley, so I found that interesting. I'll link all of that below in the comment section where I expect you to tell me, my dear viewer, something, anything. Please, I'm tired of talking to myself. Since you're watching this though, I'll do my best to summarize all these resources for your viewing pleasure. This is highly contextual. One CRA ruling may or may not apply to you. And please note, look at the interpretational bulletins. The guidance comes from documents published in the 1980s. This tells you that there's really nothing new under the sun. And I believe this is why Canada operates under the rules-based frameworks instead of line-by-line codes. It's because there will be new assets, there will be new financial structures and different business models. They can't keep changing the law every time. It's not just because they're intentionally obfuscating information.
Redacted.
So let's break down the classification then. Let's look at the first question. Did you run a business or did you invest and qualify for capital gains? IT 459 tackles this. It's known as the adventure or concern in the nature of trade. According to this, you can tell if you're a businessman or woman based on 3 things. Point number 1, whether you dealt with the property acquired in a manner that the dealer of such property would deal with it. Point number 2, whether the nature and the quantity of the property excludes the possibility that the purchase was capital in nature. Think of it like getting caught with recreational amounts versus getting caught with the intent to distribute. You know what I mean? Point number 3, whether the taxpayer's intention as established or deduced is consistent with the motivation of trading. So we gotta do some deducing, detective work now. So how does the CRA prove your intention, since I can't find a Vulcan anywhere to prove what I was thinking at the time of purchase? Here are some considerations the CRA has used in the past. Read the actual interpretational bulletin if you want to be confused. But here are 6 points to consider as my simple brain understood it. Point number 1 is length of ownership. How long did you hold your position for? If you're a day trader versus a swing trader, you're less likely able to defend this, because if I take longer to choose a Netflix show than you take to go in and out of positions, you're probably doing business. Point number 2. How about the number or frequency of transactions? When you're in business, you don't sell the business assets. You sell inventory. You don't sell the bees, you sell the honey. You don't sell the heifer, you sell the milk. You are constantly buying and selling shares. It doesn't look like you're investing in capital. It looks like it's inventory. So someone who flips homes actually treats the houses as inventory, unlike somebody who buys the property for rental income. So that could be used to determine whether you did business or not. Point number 3, what is the relationship to the taxpayer's business or line of work or background in education? A realtor who buys and sells his own units has a higher likelihood of getting disqualified from capital gains compared to a hairdresser. So what this means is what you call yourself matters. If you immediately declare to Facebook and Instagram that you're a day trader after buying the $7,000 guru course, you best be prepared to pay taxes like a day trader. This also applies to time invested in education. Realtors spend a lot more time canvassing homes than non-realtors do, so they embark in more research than the average person. The same thing applies with traders. If you're at your desk at 5 a.m. every day before market opens at 7, pretty high odds that you're doing business. I'm in Calgary, by the way, so that's 9 a.m. for my Eastern folks when the market opens. Point number 4. How about other activities that you did to improve or market the asset? So when flippers put lots and lots of elbow grease in a unit, they are improving its marketability or resale. The question I have with this is, in this new era, when you as a speculator are taking screenshots of your positions, can the CRA consider this as marketing your inventory? That would actually be interesting, wouldn't it? Were you peddling your positions when you're sharing it on Facebook? Let me know what you think. Point number 5, can you prove that you acquired the asset or property for leisure or some sort of personal use other than speculative investing purposes? This is still hard to do with crypto because it's not recognized as currency. Unlike when you buy euros to plan ahead for a vacation, you're acquiring that currency for personal use. With crypto, unlikely. Point number 6, going back to the root word, which is intention. Of course, this could change throughout your holding period, but we've all heard of traders becoming investors because they kept on waiting and waiting and waiting to cash out of their losing positions. This is also true for real estate. Maybe you had the intention of holding it for a long time, but out of nowhere, someone makes you an offer that you just can't refuse. They give you a 20% premium within days of having the title. If you can prove that they reached out to you and you not going to them, this could still potentially qualify as capital gains because you had no intention. So you applied all those 6 points to your situation and you have a feeling that you were involved in business operations and you won't qualify for capital gains. What do? You call a CPA. I know that seems like a cop-out, but make sure when you do, ask if they've dealt with traders before. Because those 6 points that I kind of just mushed together are there to give you ideas, not to give you financial advice. I'm not doing this for that. I'm doing this for the likes and the subs. So go ahead, smash that like button for the algorithm, yo. Subscribe and get notified. Clout me, baby, clout me. But let's say you're 100% sure you're in business. Is there a plus side? Well, yes. As an investor paying capital gains, you can't deduct the cost of research and operations like traders can. So if you have a subscription to software, had to buy new computers that are extremely reliable, extra monitors, and you have dual internet providers at your home so that you can never go down, those are deductible from your trading profits. You may be able to deduct portions of your mortgage interest or your rent, home insurance costs, property taxes, essentially bills that you would have had to pay anyways. So there is some plus side for it being qualified as business income. If you happen to lose money from trading, you can also use it to reduce other sources of income, unlike capital losses, which can only reduce capital gains. Let's say you lost money from selling a home. This is unfortunately common in Fort McMurray right now. You can't use those to reduce your employment income. However, if you lost $10,000 from trading, you can use that to reduce income from employment or other business income. If you went through this video and thought, okay, I'm not a trader, I don't have business income, what do? Still call a CPA, but only after watching this video on capital gains. Until next time, stay aware, take control. I love y'all. Peace out. If you're still here, you should really subscribe. Click the button. Come on. I don't know how to wink. Bye.